Well, speaking of the banks, all eyes continue to be on what is happening in the world of the Federal Reserve. On Wednesday, we expect to hear from Fed Chair Jay Powell. Earlier today here on Yahoo Finance, Brian Cheung and the first trade team spoke to St. Louis Fed President Jim Bullard. Brian.
Hey, Miles. Yeah, so Jim Bullard speaking with us this morning, and one of the first questions that we asked him was really on this idea of negative interest rate policy. So as you'll recall, at the end of last week, there was some buzz over whether or not the Federal Reserve would actually put some negative interest rates into practice because you had Fed funds futures markets pricing in below par contracts, which would imply a negative interest rate sometime in early 2021. Jim Bullard saying he doesn't necessarily think that would be appropriate for the United States, kind of echoing what we had already heard from Fed Chairman Jerome Powell in previous months. He said that there were certain nuances about the short-term funding market here in the United States that wouldn't be appropriate for negative interest rates, and that has echoed other commentary from other Fed speakers today, namely from Chicago Fed President Charles Evans, in addition to some other folks that have said they also don't feel that negative interest rate policy is appropriate. But broadly had the chance to speak with Bullard about his projections for the U.S. economy for the rest of this year. Here's what he had to say.
When you're in a crisis, you do what you can. And I think the response has been quite good here. And we've had, we're doing the right thing, and all is actually going well so far. And I'm hopeful that we'll have a good transition in the third quarter, and we'll get back to pretty close to normal by the fourth quarter.
In that interview was that he could see a pretty quick rebound, something of the likes that we've never seen before. So he said that the second quarter GDP data should be historically terrible, but that he could see a positive record being set in the quarters after that as well. And that clip that we just played for you insists that maybe we could see that in the fourth quarter. So Jim Bullard saying if you want to call that a V-shaped recovery, you can call it a V. Miles, it sounds to me indeed like a V. So some optimistic words from the St. Louis Fed President James Bullard right there.
Yeah, Brian, it's interesting, whether it's a Fed official or strategist on Wall Street, it seems that everyone is moving towards this idea of a V. They're just redefining what the bottom of a V looks like. And I think at this point, 4 months of depressed activity, there's been chatter going around that, every summer we basically have a recession. We just don't call it that. So I don't know why turning off and turning on the economy should be such a big deal. But certainly there is a sense, at least at the Fed, that they like what they've done. They don't necessarily feel compelled to do more. But I do think implicit in the market's rebound is more fiscal support. And I think at this point in the proceedings, any new fiscal measure is going to have to be accompanied by some sort of new facility or new reassurances from the Fed.
Well, I think, too, when you talk about what's already implicit to these Fed policies or fiscal policies, what's also implicit in Fed communication has to be optimism over what the economic recovery is going to look like, right? It would be really peculiar if we had some Fed official come out and say, well, honestly, I don't think we're going to see anything close to a V-shaped recovery, and we're not going to get back anytime soon, because that would be some acknowledgement that monetary policy got it wrong, right? So the idea of monetary policy, especially on the low rates front, if we shift the focus away from liquidity facilities, is to try to set up the U.S. economy for a springboard, if you will, once the economy around the country does indeed turn back on, that you would have businesses taking advantage of those low interest rates to then finance investment and help drive GDP. Because as we know, the C and the I components of GDP are just so critical, especially for the U.S. economy. So Jim Bullard shouldn't necessarily be a surprise that he's providing this level of optimism, but the degree to which you have the confidence that the fiscal policymakers will be able to get the health implications of this to the side is a whole nother question. Everyone that we've spoken to on these programs have said really whether or not we see that W-shaped recovery, in which case we have a second resurgence, has nothing to do with the monetary policy conditions. It has everything to do with a possible resurgence on the epidemiological side of things in the coronavirus.
And then just quickly, obviously, negative rates is the thing that we've talked about for a number of years. It makes its way into the conversation yet again. Bullard's still skeptical on that front?
Yes, he was skeptical on that front. He was saying that, he doesn't think that the short-term funding markets are really fit to do that here in the United States. Now, of course, you can make the argument that neither were the short-term funding markets in Japan or in Europe before those central banks ultimately decided to do it themselves. I do want to note that the language that Jim Bullard used, and for that matter, Chairman Powell also saying in that it's not appropriate, that doesn't necessarily mean that they've ruled it out. And I think that's an important distinction, that Fed speakers haven't officially said we'll never do negative interest rate policy, I think that's because they would approach that language with every tool. They don't want to leave anything off the table. And actually, if you recall, John Williams made that speech, I think it was over a year ago, where everyone got kind of concerned because he said, well, I wouldn't take any tool off the table. And everyone said, well, maybe that means that we could see negative interest rates whenever that next downturn ends up coming around the corner. No one realized how soon it was really going to be. So I think it's still on the table. And, you saw that in a lot of these Wall Street notes. You had Morgan Stanley that said, look, the Fed didn't even conclude its framework review, so it is unlikely they're going to do negative interest rates, at least by the June meeting. Keep in mind, it's June 9 and 10 is the next FOMC, but you can't necessarily rule anything out. So who's to say that some other macro event might push the Fed ultimately to do negative interest rates? It seems like at least Fed funds futures markets say it's not out of question.
Well, if they're going to take negative rates off the table, but on the other side start monetizing the debt explicitly, then I'm fine with that trade. I think the former has a lot more, or the latter rather has a lot more impacts than the former. But that is a debate certainly for another time. All right, Brian Cheung, thanks for joining us.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.